the world we're in where people don't want to talk. They want to correspond via text, email. They don't want to have conversations. The old saying about those who fail to plan to fail, there's nothing that's got a bigger problem in this world. Understand before you ever buy anything, what am I going to make? How am I going to make it? When am I going to make it? If I can't answer those three questions, don't do it. People pay me a fee to keep their money theirs. And we like to say, you've worked hard for your money. We work hard to keep it yours. The reason they do that is that they want to get off the Wall Street roller coaster. Boom, 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 boom. Real estate has slow movement because it's considered illiquid. I'll tell you, a lot of them are sitting on it because they don't know what to do. Rip the Band-Aid off. Get rid of that thing. Reset. Move forward. There's information on all that stuff up there. Why? Because I want my audience educated.
Hey everyone, welcome to another episode of Commercial Connections, Investing with Confidence. I'm Brittany, the producer of the show, and today we have an incredible guest joining us. David Moore is here today. David is the CEO of Equity Advantage, Incorporated, a nationally recognized leader in 1031 exchange facilitation. Since founding the company with his brother Tom in 1991, David has helped countless investors navigate the complexities of 1031 exchanges, reducing tax risks and minimizing portfolio value. As a highly respected expert in the field, David frequently shares his knowledge with realtors, investors, attorneys, and property owners through seminars and educational events. He's a power sponsor of the Certified Commercial Investment Members, a former board member of the Federation of Exchange Accommodators, FEA, and has played a key role in expanding 1031 exchange resources across the Pacific Northwest. Outside of his work, David is deeply involved in his community, serving on several charity boards and staying active with the Rotary Club. Leading today's conversation is your host, Rene Nelson, an award-winning CCIM in the Eugene, Oregon area. Rene has spent years helping investors grow and refine their portfolios through strategic commercial real estate investments. Before we dive in, David, I just want to welcome you to the show.
Thank you, Brittany. It's a pleasure to be here. Thanks for inviting me to be on board and putting up with my my conversation for the next hour, I guess.
We're excited to have you. So I listened to a little bit of your podcast that you started last year. And one thing I heard you talking about 1031 exchanges was, although it is a tax deferment strategy, you see it more as an investment strategy. Can you talk a little bit more about that?
It's really interesting because 1031's been around for over 100 years at this point. And think of AI, think of everything that's happening in today's world. Think of the world we're in where people don't want to talk. They want to correspond via text, email. They don't want to have conversations. And really, 1031, there's an opportunity cost to it. We like to say it's not a tax or legal decision. It's purely an investment decision. And which leads me to, you're doing this thing, you got to understand there's a cost associated with it. Now, I don't mean an economic cost. I mean, the cost is you've got a finite period of time to make things happen, and so it's planning. And this, I think, one of Rene's strengths. We like to say it's not the deal, it's the destination. So you got to look at it and say, okay, hey, first thing I want to know, and people ask all the time, when do I want them to think about an exchange? And I'm going to tell them when they buy the property, because I know they're not going to own it forever. Worst case, think about it when you contemplate a sale. And the first call you're going to make is you're going to talk to your tax people, understand what the tax consequence of that transaction is, that disposition is. And then you can start looking at, okay, what do I need to do? Rene's sitting here right now listening to me, but the biggest problem she's got is she's always racing that 45-day ID period. That's a big trap. So the old saying about those who fail to plan to fail, there's nothing that's got a bigger problem in this world. This morning I was on a call with a guy, and he's talking about selling a property, and the last few years have not been kind to people. So he's got $1.7 million property, $1.4 million, let's say, in debt on it. And you're looking at a world, I mean, Rene, you think about loan to value that's available in these things. And I'm saying, okay, one, tell me what your tax liability is, because you can pay me a fee, and my fee's nothing, okay? My fee's a couple $1,000s to do this thing. But the deal is, if he does this transaction, he's probably going to have to put money into the deal, and he's going to have to do this and buy something in this finite period of time. And so you always are looking at, where are you today? Where do you want to be in 2, 5, or 10 years? And how do we get you there? And I know that's one of those strong points of Rene and the way she was taught to deal with real estate. I was always taught, understand before you ever buy anything, how am I going to make it? What am I going to make? How am I going to make it? When am I going to make it? If I can't answer those three questions, don't do it. All the exchanges is conduit out of what you don't want into what you do want. And it's an easy choice for you because you can say, okay, hey, as soon as you understand the tax consequence, then you get to decide whether the exchange makes sense. And in today's market, we have a lot of people that are just setting up an exchange to buy 45 days to see what's out there. And I'm going to tell you, if you get that 45th day, don't just put something in there, ID something just in case, because what might happen is you put on a property on the 45th day, there's something called 1031 G6. I can't release the money till you've purchased everything you have the right to buy. So imagine a situation where they get into the exchange, they burn through the 45. On day 45, they say, God, the tax consequences, this, I don't want, I'm just going to put this in here just in case. And then Rene comes to him on day 60 and says, hey, I found your property. I can't give him the money. So the whole thing is planning. And if you're just doing it and you're just on your heels the whole time and, you didn't really think about the exchange, I get the call to set it up. We like to say our company is an investment-based company. We look at it all about, you got to make sense of the transaction. And we've got a sister company, IRA Advantage, that handles tax privileged money. I mean, qualified funds, IRA 401k funds. And when people come to me, I look at, okay, so whether we're talking the tax world 1031s or the qualified money world, IRAs 401k plans, we don't sell investments. We don't give investment advice. We just listen to where they are today and where they want to go. We're going to create the investment vehicle that empowers them the ability to go get there. But I don't want them just throwing good money after bad money and putting an exchange together that's pigeonholing them into a situation that is not right for them. So I'm after 35 years almost in the business, I don't have to do the deal. Okay. And if it's not right for them, I'm going to tell them. And it's a nice place to be.
So David, for the listeners that maybe are unfamiliar with 1031 exchanges, can you just give us a quick overview? Because there's some rules. You have to go even or up in value, even or up in debt. And like that scenario you just gave us with the guy's got a $1.4 million debt, he's going to have a debt coverage ratio problem. So you want to kind of give us the nuts and bolts of an exchange?
Exactly. And, that's what's funny, Rene, because, we start talking about it and you think, so if I look at, and we have a lot of people that come to us with we'll talk about that later, funding projects. And I have a lot of people coming and say, well, hey, do you have any exchange people that want to buy into this? So we've got institutional TIC people, we've got DST people, we've got other people with projects, and they're always looking for money. And they look at 1031 money, and 1031 money is not patient money. People live off the income off that money, and they've got a finite period of time. And Rene, as you just said, typically they're going to have some requirements, value and equity requirements in association with that. I've got a number of builder developers, investment people these days that come to us looking for qualified money. And the reason that's so attractive is it's patient money. Okay, so 1031, back to your question. So qualified money, they're not going to touch that money until they take a distribution at the end of the day, which is no earlier than 59 and a half without a penalty, or 72, they got to start taking it. But the 1031 stuff has to work. I like simple. Okay, so 1031, when you look at a 1031 exchange, I'll break it into my four cornerstones. One, it's got to be an exchange. Renee's going to sell something for them. She's going to find them what to buy. Really, the accommodators just paid a fee to structure that exchange. We step into the middle, we're paid a fee to turn that sale and purchase into an exchange. It has to be an exchange. Two, what's going to receive got to be of like kind. The like kind requirement, one of the biggest fallacies, I think, I got to go land to land, house to house. It's never been that way. All right. So like kind refers to the nature of the investment, any real property held for investments, like kind with any real property acquired with the intent to hold for investment. Now, define property held for investment. Define a primary residence, for example. Now, Rene, you've got a lot of high net worth people you work with. If you're doing a transaction, let's say you're doing a $10, $20 million project, the person that owns that thing probably has a house that's maybe worth $3, $4, $5, $10 million, right? And you look at the gains on that and you think about Section 121, people pay me a fee to keep their money theirs. Okay. We like to say, you've worked hard for your money. We work hard to keep it yours. And so we're not just going to look at the investment stuff. I'm going to look at everything they've got. A lot of people, let's say during COVID, started working out of their home. They work out of their home. They've got a home office. Their tax people might say, well, gee, now you're working out of your home. You got the home office. Let's treat it as such. So let's say if they've done that for more than 3 years, they go to sell that home. They don't know it, but that home office is going to be taxable to them. They're going to have depreciation recapture. They're going to have a tax hit on that piece of the home. So we'd have to do an exchange of a portion of that property. So people don't understand 1031 can be applied to a lot of different things and should be. And you think about the number of people that have homes in excess of 250 or 500 in gain, they have a choice. They're going to pay tax on the overage. They can move out of the property. And the nice thing for a commercial broker is, hey, you're selling somebody this big project. You got to think if you hear they're selling their home, you say, hey guys, think about this. Maybe you ought to move out of the home. As long as they sell it within 3 years of moving out, they can then take the exclusion and then 1031 the overage. And the same thing can be done. So we can convert a home into an investment. We can go out and acquire an investment, turn it into a home. So that's that like kind requirement. Any real property that's been held for investment is like kind with any real property acquired with the intent to hold for investment. 3, and this is a big one. This is one of the biggest. So 2, the like kind issue is a big fallacy because people think it goes dirt to dirt, building to building, so on and so forth. And there was a proposal in the late 90s that would have taken ag land out of it because the government was concerned all these wealthy people were buying ag land, taking it out of production. Fortunately, that didn't happen. So any real property held for investments like kind with any real property acquired with the intent to hold for investment. 3, for total deferral, they need to go across or up in value and equity. Now, it's not all or nothing. So whatever your tax basis is on the relinquished property, every dollar you spend over that basis represents tax deferred gain. The other thing I want to say is you're triggering a gain on the disposition of this property, okay? That creates tax exposure. That doesn't mean you owe tax. So the guy that I mentioned earlier, I said, look, you're selling a property in the first quarter of 2025. If you've got a stock portfolio, think about what it did after the election. It probably went through the roof. Okay. I mean, it went way, way up. What's it done in the last couple of weeks? It's crashing. Okay. So the thing with real estate, a lot of people in Wall Street, when they come to me with a desire to diversify outside Wall Street's holdings, the reason they do that is they want to get off the Wall Street roller coaster. Boom, 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 boom. Real estate has slow movement because it's considered illiquid. So you're always sort of looking at, where you're going with this stuff. But when we're looking at that value and equity requirement, we call it the napkin test. One of the big fallacies, and I know, Rene, you've wrestled with it for probably decades now. Not that you're that old, but if you look at one of the big fallacies of 1031 is you got to replace the debt. You got to replace the debt. That's not true. Mm-hmm. Debt can go away 2 ways: one by going down in value, the other by adding cash to the transaction. But I would also challenge people, like the guy this morning. I said, well, look, if you sell in the first quarter, you're going to be realizing some gain on this property, but you've got 3/4 of a year to work with your financial advisor and everybody else to say, okay, hey, I couldn't fully, back to the comment you made earlier, Rene, because you were a lender in a previous life. You look at the loan to value when we're talking about $1.7 million with $1.3 million in debt, and you start looking at backing out all the costs, the closing costs, which erode that 400, ends up getting pretty skinny. So now maybe we're at 200 to go out and buy another $1.4 million or $1.5 million worth of property. That's pretty skinny. So you got to look at what else is going on. So you're always sort of juggling these things and saying, okay, how do I get there? But when we're looking at the value and equity requirements, that's all it is. And think of it from the context, every dollar you spend over your basis represents tax deferred gain, and it's not all or nothing. I've literally had people say, hey, my target number is $1.5 million. I've got the property tied up at 147. Should I pay the extra money so I don't have any tax? I'm going, you're nuts. Every dollar you spend more you want costs you $1. If you don't spend it, you're looking at maybe paying, 40 cents on the dollar in tax. So spend what you want, understand what the tax repercussions is going to be. So 1, it's an exchange. 2, what's going to receive your like kind. 3, we're satisfying that napkin test, which says the cross are up in value and equity. And then the second biggest problem, second to time in an exchange, is continuity of vesting. That's the 4th cornerstone. And that just means that the person that gives us something has to be given something back. You think that sounds easy. If we've got a property, let's say Rene gives me a property, I'm going to give Rene the property back. If Rene wants to buy into a property with the 3 of us, she can do that tenancy in common, but she cannot do that into a limited liability company because partnership interests are specifically prohibited. Now, and I know Rene's dealt with this issue. You think, well, that's pretty easy to understand. Husbands and wives, you think about the difference between spouses owning properties in Washington or California versus Oregon. Okay, this is how easy this vesting issue gets to be a problem. Because what will happen is we're not a community property state. So what will happen is people will buy the first rental house and they get another rental house and they get another rental house. And then they go talk to their lawyer and their lawyer says, you know what? Now you got all these properties. You ought to shove them into an LLC because of the liability that you have exposure to. So they do that. And then they sell one of those properties and they come to me and then they want to go buy the replacement property. They're talking to lender. It's 4 units or less, it's residential loan. And now they're mad because I'm telling them they have to buy in the LLC, spouses in this state, because we're not a community property state. So even spouses in a LLC are a legal partnership and we can't have them give us the relinquished in the LLC and acquire individually. So
okay, so those 1031 exchanges don't work with a spousal LLC.
In California or Washington, yes. In Oregon, no. We can do the exchange for the entity, but where the problem is the financing on the acquisition. Because if they give it to us in the entity, we have to give them the replacement in the entity. If they're California or Washington residents, they can give us the property in the entity and we can give them the replacement individually. Oregon residents, we can't do that. So that's that whole thing with really planning ahead and having people, I like to say, to do these things right, you got to have a team of people, right? Yeah. And that team's going to be good, competent tax and legal people you're paying to put a position on something, not paying to learn on your client's behalf. You're going to have great brokers. You're going to have finance people. If you got income properties and you're not managing them, good managers, a great facilitator, good title escrow people, right? So it takes a team, and it's a complicated world. It's a complicated world.
I have referred a client to David's firm, and she's in an exchange right now. So I sold her 12-unit apartment complex in Eugene. She owned it in an LLC with her other 2 siblings, so a total of 3 siblings. And I think the mom might have been a partner also, but everybody was in an LLC. Everybody else wanted to cash out at the closing table, take their cash, pay the tax, but this one individual wanted to exchange forward. So I hooked her up with David's company, and she wound up looking at residential property because it was below $1 million. And it's really pretty hard to get into commercial with below $1 million. So she decided to buy some residential property that she was going to make into like Airbnbs. But then she realized that she had to buy in the name of an LLC. And as David's inferring, now she's got a lender problem because 1 to 4 family units fall under Fannie Mae guidelines, and Fannie Mae will not let you put a loan in the name of an LLC because they cannot pierce that LLC if they need to foreclose. So they'll let you put it in a revocable trust, but not in an LLC.
Rene, and you were a lender. I'm sorry I'm spilling the beans if people didn't know that. Okay. You didn't want them to know that. But it's so ridiculous because, if we're looking at small properties, it won't allow you in the LLC. If we're looking at big property, they require it. Okay? It isolates them from liability on the property. It does not isolate them from the obligation to paying the loan. So, that whole argument is, I'm sorry, technical term BS, right? You just sort of look at it. So I thought where you were going. So you think about that scenario. Okay, that's an example. Partnership interests are specifically prohibited. I know Rene works with that all the time. I've got another guy in the same situation. When I first met with him, as a portfolio of properties, I can't remember, 1 or 2 sisters and another brother. So I can't remember, it's 3 or 4 people in the property, in the LLC. They've got a series of properties, and everybody at some point in life, people want to go different directions. So anytime we're creating things, we have to understand. I said, look, you can create this entity to own these things, but understand that at some point people are going to want out. right? So you always have to look at and establish, a policy procedure going forward and how we're going to get people where they want to go. And we do technical term drop and swap, swap and drop. And we'll have to do this again because we only got an hour and we're already half hour into it. But so I've got another client in similar situation, but let's take it a step further. So this guy is, and let's just say it's three. In this case, it's two. There's three people in the LLC, three siblings. They're all in their 60s. They're wanting their own things. And so my client, so I shouldn't say my client, probably all three are my clients. At the end of the day, they will be as soon as they understand what's going on here. So if we look at their transaction, client A wants to buy client B and C out of their respective interests in a given property. Okay. So what really needs to happen is they need to drop into a tenancy in common, ideally, let's say a year predisposition, which I'm going to just drop this bomb in a second. Actually, right now, there's no stated required hold in 1031. Okay, I'm going to say that again. There's no stated required holding period in 1031 outside of a related party transaction. One of the most viewed videos we have on YouTube is the fallacy of a 5-year hold. That has to do with the property acquired via 1031, converted into a residence, and then later sold inside 5 years. It's a fully taxable sale. A lot of people think, hey, gee, I'm going to exchange out of this property, go buy a property, hold it as investment, move into it, live in it 2 years, sell it, and get rid of all my gain. It doesn't work. Okay, it worked in the late 90s. It doesn't work. There's on top of that, there's something called the Housing Assistance Tax Act of 2008. But if we're looking at that scenario, so my guy Andy wants to buy one of his siblings out, which he can do. So a related party transaction, you can sell to a related party and do an exchange. You cannot buy from a related party in an exchange unless that related party is also doing an exchange, and both of you are going to hold your replacement properties for no less than 2 years. So I say, Andy, so your brother he doesn't want to do an exchange. So if he does an exchange, Andy can buy him out. If he doesn't do an exchange, Andy can't buy him out. I said, well, what do you want to do with the money? And Rene, this is a conversation I know you're having with people. They want to go to cash. They want to go put the money in Wall Street. Okay. So that's what he told me. I said, Andy, and at the top, I said, I want to know where they are and where they want to go. I said, okay, Andy, tell me what he wants to do with the money. Well, he wants to put in Wall Street. And I said, okay, so what kind of yields he looking at? He said, 3.5 to 6. I said, okay. So is that 3.5 to 6 with the gross sale and what's happening? Or is that after he's calculated the 40% tax hit he's taken to get that 3.5 to 6? And the financial advisors all want to pull the money out and they say, well, hey, I'm going to give you this. Let's take the money, go do this. But you're taking a 40% haircut to get that money there. How long is it going to take for him to make himself whole just to get back to where he was, let alone make the 3.5 to 6? So I said, Andy, if he doesn't want to deal with the properties, I would just say, look, let's do an exchange for him. If he wants access to money, let's get him into a Delaware Statutory Trust, but let's take it a step further. Instead of just buying a DST, which the money's going to be locked up with, and once again, this is giving people a place to go. I want people to think, and back to my facilitation comment, I want people to think of the exchange. I want them to think of these things. If you're an investor and you're driving down the road and you see some ratty property that you think you can do something with, why's the person got it? What are they doing with it? Are they just sitting on it? Because I'll tell you, a lot of them are sitting on it because they don't know what to do. They can't afford to take care of it, but they don't want to take the tax hit to get rid of it. So give them a place to go. Instead of just saying, hey, I want to buy your property, when I say, what are you doing with the property? If you could do this, would you be interested? So what I told him, I said, look, let's do an exchange for him. That way you can do your exchange into the property. And let's put him into what's called a 721 UPREIT. And once again, I don't sell these things. I don't get a penny if they buy them. 721 is pretty cool. For people, it's an end game. So what that means is he's going to do the exchange into the Delaware Statutory Trust. It's going to be held as such for, let's say, a year to 2 years, at which time it gets rolled into shares of a real estate investment trust. As soon as it's rolled into a real estate investment trust, the downside is that there's no way of getting out without a tax. But the upside is he's free to sell shares anytime he wants. So back to my comment on gain and gain exposure versus realized gain. But the big magic thing about a 721 is the tax treatment of those future REIT sales is flipped upside down. So typically when you sell something, you pay tax through the gain until you get the basis and you get your money out. And that's a real eye opener for people because you think, well, gee, when I bought the property, you put $500,000 in. So I just want to pull the $500,000 out. I shouldn't have to pay tax. No, you're going to pay tax anything you pull out until you get the $500,000. Then you get the $500,000 at the end of the day with no tax. But the 721 it's like the ultimate installment sale. One, you don't have worry. You don't have a worry of acceleration. You don't have a worry of default. You don't have a situation where you're paying tax on debt relief or depreciation recapture in the year of sale, which is a big eye opener for people who don't understand. And then finally, what happens is instead of paying tax through that gain, as I said, you can literally sell through your basis with no tax exposure. As soon as you've done that, then you start paying tax. So back to Andy's brother, if he does this deal, he's got to be patient. But by being patient, he's not paying 40% in tax to get his 3.5 to 6, and he can then sell through the basis with no tax consequence, take that money and shove it into Wall Street.
That's really cool.
Wow.
So it's all about, you don't know what you don't know, right?
Yeah.
And it's all about options.
That's why you need the team.
Exactly. Giving people a place to go and really taking the time to plan it out.
So tell our listeners, the guy that you were talking to this morning that was doing the $1.7 million exchange, where's he headed? What's his plan now?
Well, originally I was thinking about like a fourplex or something. I said, well, you're looking at 90% loan to value, right? I mean, where are you going to get that loan? You could get through seller finance, but really he's probably going to have to put money into the deal, and he's still skinny on it, still not. So he's taking money from somewhere else to get a property that's really not going to cash flow. So I sort of suggested there are things in the Delaware Statutory Trust world that are 80% loan to value, non-recourse debt. And in that space, it's not going to give you a check in the mail monthly, but during that 5 to 7 year hold, you're going to be having a buildup in equity. And at the end of the day, you're going to have some money there. Your option is you do that transaction. You're not getting money monthly, but you're not having to come out of pocket 40% on the gain that you had. And his gain, by the way, was about $600,000. So it was going to cost him, $150,000, $180,000 in tax if he doesn't do anything.
Okay, so I had planned to have session 2 or 3 with you and ask these more detailed questions, but I mean, we're in the thick of it. So let's just keep diving in.
Yeah.
So this investor going into a DST, for people that don't know, their DSTs in the past years have kind of gotten a bad rap because you always hear that you can get into them, but it's almost impossible to get out. But now I'm hearing the strategy of be in it for a couple of years and then go up to the 721. What's the requirements to be able to go into a 721? I'm assuming you have to be a qualified investor.
First off, I say we're working on the liquidity component. So keep an eye on DSTliquidity.com. It's not up and running right now. It's bookmarked under construction, but that should be coming to light in the next 6 months if I can get it all handled. And that'll take care of the liquidity issue. But if we're looking at 721s, you've got to be buying into a DST that has that 721 component. And the issue is, I made a comment earlier about holding periods in 1031. If somebody asks me how long I want to see them hold something, I'm going to tell them a year, and that's based upon a couple of factors. One, it's been proposed a couple of times, and two, that's the break between short and long-term tax rates on assets held for investment. With that said, I can give you a court case where 4 months was deemed long enough, and that was in a much more egregious area, I guess I would say, because it was a tax court case where people bought a property, they exchanged out of an investment property into a quote unquote investment house, moved into it after 4 months. All right. And I mean, I know if somebody's given up, they're not buying some little rental house someplace, they're buying a multi-million-dollar rental house. It's probably not a rental house. Okay. So, and like I say, you can convert things back and forth, but I'd say a year is comfortable based upon a couple reasons, but ultimately it comes down to that tax vow. I want, and this is what I told the guy this morning. This is what I told Andy the other day about doing stuff. I've got a guy that called, I talked to him this morning. He's selling, consider a situation where the guy's living in a fourplex And he thought he was too late because he's got the sale and the purchase in escrow. And he's got a fourplex. He's living in a unit. Dad was living in a unit, and 2 units are pure investment. So if you sell that property, we're going to have the sale of a single asset, and it's got allocations section 121 and 1031. And the question is the 1031 component 1/2 of it or 3/4 of it? And that's really a question of how long he can show that the third unit was deemed to be held for investment rather than resale. And you've got to really look at and in that transaction, the problem is he doesn't have tax people. Okay, so I'm getting him in touch with tax people because I'll tell you, if I get audited, and I live in this world, but if I get audited, my tax people are going to tell me to shut up and sit down in the corner, and I'm happy to do that. Let them deal with it, right? So the tax people in that transaction are going to be deciding on whether that third unit, that other 25%, is investment or something like a second home, which has really got a different set of rules there. But you're really looking at that whole picture. If you're looking at that DST and the 721, and we look at hold periods, you're never going to see that DST offering. One, they're typically offered with that DST. It's not an elective rollover. Okay, it's typically that offering is going to all go 721. So you got to sort of look at it and make sure, talk to different vendors and see. And Rene, I guess, one of the other comments you said, there's been some turmoil in that space. And the turmoil is this, because anytime there's a shiny nickel, last Friday, I was in Carlsbad, an oil and gas conference with a company I speak on behalf of, and it was their vision tour, and I was just minding my business in the audience, and all of a sudden I'm asked to speak, and so I stand up, and because I was asked to speak because people were frustrated with trust companies and qualified money going into it, and then that ended up dovetailing into some 1031 conversations. But the issue is, you can't shift gears in the middle of this thing. Typically, the DST offering is either going to be 721 or it's not. And the question is holding periods, how long things have got to be held. And they're never going to have if it says, okay, you're going to the 721 and it's going to be 1 year from acquisition of the DST and it's rolled, if the whole time it's set to convert, is it held for investment? If the three of us own a property, and Rene, you've been through this a number of times, if the three of us own a property via limited liability company, I'll have a conversation a year ahead of time with the tax and legal people and say, okay, guys, this is what we're going to do. We're going to break into tenancy in common, hold it for a year, and then sell it. And then we can all go do what we want to do. 9 times out of 10, a year later, I get called the deals in escrow, and that break never happened. I said, guys, why didn't it happen? Well, because there's a series of things that have to be done to break the entity and defendably do it. And one of those things, and once again, back to Rene's previous life in finance, is if we change, if the property is owned by a limited liability company, now we drop into a tick, is there an acceleration provision in the loan that's going to be a problem? Furthermore, if we're talking multifamily stuff, you've got to amend all the leases, everything involved with that, because it's no longer owned by the entity. It's owned by maybe the three of us directly, or the three of us probably more likely via 3 different limited liability companies. The tax returns. You got to close out that partnership, move forward, do everything, treat it truly as a tenancy in common for the year predisposition. And you've got to have a TIC agreement spelling out the operation of the property, bank accounts, tax returns, all that stuff. It doesn't happen. So what happens 9 times out of 10 is the deal gets to escrow. Then all of a sudden, now we're going to drop from the entity to the tenancy in common, and it goes away. And people call up all the time and say, well, should I do it now or should I wait till close? Or maybe it's on the market. Should I do it now or should I wait till it closes? If it's on the market being sold and you make the change, even if it took a year or 2 to sell, it doesn't matter. You never held it for investment because you had a sale, you had the thing for sale the whole time. So when the DST sets up these 721s, typically it's not going to be a hard stop as far as when that conversion is going to happen. So it's going to be, company specific. When we look at the turmoil that was in the DST space, I'll say this. I'm at an age when Tom and I were young and we started investing in properties, we buy something, nothing down. One of the first investment books I read was Robert Allen's Nothing Down book. And hey, I'd live it all day. And if the property went away, I was in my 20s, I didn't care. Today I care. Yeah, I can't make it back. Today, I'm more concerned with wealth preservation than the ultimate ROI on something. So, and I deal with lots of clients that way. All right. And so when you're looking at these things, you got to do what you can to be as conservative as possible on it. And so when we're looking at timelines and converting assets, ownership vehicles, we've got to be protecting this stuff. When we look at the DSTs, what good is tax deferral Once again, the opportunity cost, right? Because not only do you have a finite time of doing the deal, you have requirements of value and equity through the exchange. The exchange is not always the right thing to do. Maybe you want to do a QOZ. Maybe you just want to walk off in the sunset. All those things are possible, right? And we want to give them those options. But when you look at the DST space, I'm going to tell you this. They sort of started right around 2000, and then we had the blow up in 08, 09, all that. By that time, so you went from the foundation of that industry to, let's say, 65 to 70 sponsors. Pretty quick growth. How many do you think were left after the crash? A half
10.
dozen. Yeah.
Oh,
Yeah.
yeah.
You maybe 10. Okay. Half dozen. And, one of them was Cantor Fitzgerald. Okay. They're CEOs on one of Trump's committees now. These people have been in business. They own Newmark Frank. They've been in business 40, 50, 60 years. Cantor Fitzgerald, Inland Private Capital, Pasco out of Southern California. That's 3. Okay. There's a few more in that heritage group. So after the crash, we had that group. How many are there today?
Oh, I bet you it's back up.
There's
big.
100 plus.
Wow.
100 plus. Okay. So the oil gas conference I was in last week, okay, Troy Eckert, good friend, he's up there and he's going, what was Trump saying before the election? Drill, baby, drill. Palin was drill, baby, drill. Okay. So what do you think's happened with that space? The big companies have gobbled up the little ones, but now you got what was a pretty sleepy deal because, Biden had crushed it, right? I mean, they were not only not mining this stuff, going after it, but the equipment there was being broken down, sold off because it wasn't able to be used. And now all of a sudden, all the rats are running to the opportunity, and you got a whole bunch of new people. And he made a comment, and no offense, Brittany, but Troy's like, look, I'm not going to work with anyone in their 40s because they've never seen a bad day. Because that crash, we've had a huge run up. So back to my opportunity cost of the exchange. What good is the exchange if you're deferring gain into something that goes away?
Yeah. Do you want to talk about that? Because there's phantom gain and there's some different things. So help the audience understand if they put money into like a DST and that DST collapses and all of a sudden just poof, everything's gone overnight. Then the person that 1031 exchanged in, they could have a tax consequence, correct?
Exactly. And it's really, really ugly. And most people don't understand. Okay. So during the last crash, we came up with a process where we were able to help a lot of people in the institutional real estate space that were suddenly facing a tremendous tax consequence that they were totally unaware of. All right. Now, think of the world where we are today. Okay, we've got a situation where we've got a real estate market that has done extremely well over a period of time. During COVID, it was going nuts. But we've got a lot of people that migrated out of houses into commercial properties. And Rene, you know better than anyone, the nature of a residential loan that might be 10, 20, 30, 40 years versus a commercial loan that's maybe 5 to 7 years. So you think about the people that bought these properties, they had a certain loan to value, and maybe their loan was in the 3.5, under 4%. And you look at the cost of capital today, and you may have had a property that was acquired and had X value, and now it's X minus in value. And now you might have had an LTV that was at X, and now it's going to be, when it needs to be replaced, substantially less. So I have been watching everything, and I'm getting more calls today. And I would expect more because everybody, I think, first off, let me ask you this. I mean, what do you think money should cost? I mean,
like interest rate wise?
Yeah. I mean, what do you, and it's a hypothetical, you don't need to answer, but just for those in the audience, what do you really think money should cost? Okay. And if we go back, into the 70s, 80s, and go from there, we've had money from in the high teens down to the free money portion. But if you look at, historically, how does a bank work? You deposit money and they pay you X and they loan it at Y and they get the spread. Okay. When the money was free, they weren't doing that. They were buying Fed funds, which is not real money. The Fed can't print money because every dollar they print, it devalues everything. Yeah. But, realistically, what do you think money should cost? Right. And I would say it's probably about where it should be. Every time people start talking about the rates going down, the market stops because everybody's hopeful that it's going to change things. But if they drop it, it's just going to add inflation. my advice is get used to it. Okay. It is what it is.
Mhm.
With any adversity comes opportunity. If things are too easy, it's problematic, but just deal with it. Okay. But understand that if you're looking in these situations, I've got more and more people calling because they're smart enough to understand that to refi the property is not going to work. The property is not going to work for them with a new loan in place at the new loan to value and the new interest rate. And so they're proactively saying, hey, I got to make this move. Now, back to Renee's comment. What people don't understand is if you lose a property to foreclosure, let's say that loan's due and you can't get it refinanced and you can't sell it, or maybe it's a short sale. The debt on the property in a short sale, whatever's greater, in a short sale, the loan's greater than the value that you sold at, right? I mean, in a foreclosure, you're just losing the property, period. The debt is treated as a sales price. So if the debt on the property exceeds the basis, that difference is gain. That is called phantom gain. If you had that scenario with a primary residence, you've got tax relief. Income properties, you do not. So what happened in the last crash is I'd get a call from lawyers that figured out that we knew how to deal with this stuff. They'd say, hey, we've got this institutional property. We got 25 people into it. It's going into foreclosure next week, and we understand you can help us. So what would happen is we transfer the asset for the people that had a tax problem. If they had no debt on it, maybe they didn't have an issue because the issue is driven by debt, because it's debt relief that's triggering the gain in that context. So what would happen is the asset would get transferred to us pre-foreclosure. That starts at 45-180, and you're going, gee, David, you didn't get any money. How are you deferring a gain? Equity has nothing to do with gain. Gain is simply the adjusted base, the sales price minus the basis. So the adjusted sales price, whatever the gross is, net of closing costs, you're going to subtract from that number the basis, which is the purchase price plus capital improvements minus depreciation. Obviously there's a lot of variables there because the purchase could be, if I gave you a property, your basis is what mine was. If I died and you inherited, you got to step up. If you did 1031s, you had basis carry forward. 1033 involuntary conversion, basis carry forward. The old residential rollover, 1034, basis carry forward. So really depending on how you got it, that impacts the quote unquote purchase price. During the time you owned it, every dollar you put into it, you either expense or capitalize. Then depreciation. A lot of people, one of the guys I talked to last week, have owned it for a decade, never took depreciation. What's the government's position on depreciation? You should have taken it, therefore you did. So you could be taxed. If you were audited, you can get clobbered on depreciation recapture and have never realized the benefit of it. Laziness does not count. Okay. So good tax people. So when we're looking at these things, what would happen is these big properties would go into foreclosure. The foreclosure, we get a call from the lawyer saying, hey, it's going to happen next Tuesday. And we'd have to we'd put 25 LLCs together. We'd do assignments, membership interest, convey the assets from the taxpayer to us. That starts at 45-180. And, for them, it was a pretty easy question to answer because they can either lose the property foreclosure and have the privilege of paying up to 40% for that honor. So get this, you lose everything and pay 40% on the gain, or come out of pocket 20%, go into the DST zero coupon offering and defer all your gain. And hopefully by 5 to 7 years later, you've got some equity there. No matter what, you got 5 to 7 years to plan for the tax consequence.
Well, that's quite a strategy. Wow.
I was talking to a buddy the other day, and he's one of my mentors, and Renee's the 1031 guru. I've just got to say, it's great to be on here with you, Rene, and I know he's up there smiling down on us, and he was one of my mentors too, and it was just always an honor to just throw ideas back and forth. And I'm like I said at the beginning, the CAB event, the Evening of Excellence next week, I'm the first presenter. I'm doing the Rookie of the Year, and I love that position because you got to learn from people, that have gone through this stuff, the stories, the experiences. And when you're getting started, you think, I just love youth because you think you know everything and you just don't. So getting knocked down a few times in life, it changes stuff. But to have the stories, the experiences, and the old saying is like, where you learn more, the failures or the successes. And I'm going to tell you that, when I get knocked down, I don't want to get knocked down again. So anyway, learn from my mistakes. Okay, people?
I call that tuition in life.
Yes. Oh, that's a great one. I love that. Yep.
Okay.
So write that down. Tuition in life. Yep.
In the past, we've had pop quizzes for Brittany because her goal is to learn as much as she can. So I'm going to do a little switcheroo for both of you. So David, in one sentence, tell Brittany what you would want her to know about 1031 exchanges. And then Brittany, you're going to have to tell David whether he nailed that in the presentation and did you get it?
Why do you do an exchange?
I'd say that she nailed it. What do you say, David?
I think she did a good job. I think she did a great job. Let me make one comment. I know we're thin on time. And this is something that's, when I look at my businesses and I look at my clientele in them, and you got to look at the liquidity of Wall Street versus real estate. But I know, Rene, you've gone through this, and I know you've had clients in this situation. When I'm establishing a self-directed account for somebody, it's not uncommon for us to establish the investment vehicle and to have it sitting there unfunded for a period of time. And often, if it's there for too long, our team gets on the phone with them and say, "Hey, what's going on?" And the comment that they will make is, "Well, gee, since we established this account, ABC stocks have gone down in value, and now I've got a loss, and I don't want to realize that loss." I have that same conversation with people in real estate. And my question back to them is always, whatever it is, it gave you that loss. The loss is there, okay? Whether you realize it or not, it is there. So if your stock went from 100 to 40, the loss is there. Whether you sell it at 40 or not, it's at 40. So the question really should be, what is the fastest way back to 100? All right. Is it the stock that gave you the loss, or is it something else? And with real estate, it's just a much more painful thing for people, but I witness it a lot more with the Wall Street stuff because it's just so the roller coaster, like I said. But an example is I've got a client, actually a broker that we do a lot of work with. It's a client that has an investment condo in a building downtown Portland that's got a huge, monstrous HVAC issue, lawsuits everywhere. Each condo owner, the HOA is assessing between $100K and up to $1 million on some of the bigger units.
Ugh.
And she's like, "David, I can't sell it because I've got this loss." And I'm saying, okay, so one, how long is it going to take for this thing to get back to where it needs to be? And how much money is it going to cost? How much good money are you going to throw at that thing? And then after you've thrown it at it, how long is it going to take to get back to where it's an acceptable value for you versus rip the Band-Aid off, get rid of that thing, reset, move forward. And once again, back to looking at your life and saying, okay, my comment about exposure versus actual consequence. And as I said, 1031 is not always the right thing. If you look at my YouTube channel, I've got everything from QOZs on there. I've got selling life contracts, cost seg, whatever it is. QOZs, I've got charitable remainder trust on there. Charitable remainder trust is adverse to me. A QOZ is adverse to me. Deferred sales trust, adverse to me. There's information on all that stuff up there. Why? Because I want my audience educated. I want them to understand what else is there. And my widget isn't always the right thing. And you comment about CCIM. Rene is a past president of our chapter. She's done so much work in that space. For those in the audience who don't know what CCIM is, Certified Commercial Investment Member, it's the doctorate of commercial real estate. It's NAR's commercial division. And it's an amazing organization. When we went into different areas, the reason I met Rene's husband is that when I'd go into an area in the late 80s, early 90s, I would pull out the book and see who in that area is a CCIM because it's a different level of expertise. But on the flip side, the acronym we'll once in a while use for CSIM is can't close, I miscalculated. You get into that analysis paralysis, and it's easy to just sort of sit there and you start freezing up on stuff. And my advice is always to analyze where you are. Look at where you're in life. You know what you're worth, and you sort of say, okay. And Rene, you do a tremendous job in counseling, and that counseling is you're here today. Where do you want to be in 2 and 5 and 10 years? And what's really interesting to me is, and I know you've had this happen, if you go through that exercise with people and you crank out an ROI that is required for them to get to that brass ring, the funniest thing in the world is to apply that same formula to what they already have, because they're going to tell Rene, hey, I'm not going to buy it until it does these things. And yet half their portfolio doesn't meet their own requirements.
Amen.
So
true.
So it's
true.
really, yeah. And if you look at the exchange, as I said earlier, simply stated, a lot of people in my industry are just going to hold the money. And you wouldn't believe how many transactions I get in the middle of where somebody is doing something entirely wrong, and they've called us up looking for answers, not getting the answers. I'm going, why'd you do the exchange? Or why didn't they do this for you or that? You can leave it as a paper shuffle, and I'll blame NAR for some of the problems with this, because what happens is the state forms simply will have a 1031 provision in them, and it just says it's an afterthought. It's not even a box to check anymore. It's like, oh, buyer seller has the right or the option to do an exchange. The forms are assignable, so anybody can think about it at the last second. The problem is people do that at the last second, and if you're relying upon that boilerplate form, what happens is nobody's telling escrow it's going to be an exchange. If you close the deal, you have actual constructive receipt, it's too late. So we're at the hard stop, and I'm blabbing away.
Hey, David, share your website for the listeners on the podcast so they could go and check out your stuff.
Sure. Equity Advantage, the 1031s, 1031exchange.com. That's probably pretty hard to forget. So once again, 1031exchange.com. If you're interested in IRA 401k stuff, throwing that in real estate, IRAadvantage.com or .net will get you there. You know, if you got questions, don't hesitate to reach out. Happy to address any questions, concerns you got. If I'm not available, just ask my staff to set up an appointment, or I've got a full team here to take care of any questions you might have. And we got to do this again.
We do. This was fun.
Thank you. Thank you.
Yeah. David, you knocked it out of the park. I thought we were going to do something a little easier, ease into 1031s, but you just dove right into the deep end of the pool, which is frankly where most investors are. They want the facts. They want the information, because just like you said, they're in real estate deals right now. And then they're like, oh man, where am I going? How am I going to exchange forward? They're short on their debt requirements. So yeah, thank you for the information, but we have to have segment 2 and 3.
Yeah, Sheila said to say I love you. She said to tell you that she loves you, and just say hi. So thank you so
awesome.
much for the opportunity, guys. And anytime you want to do this, I'm up for it. And like I said, you don't know what you don't know. And I think people just look at this whole process as an afterthought today, and it's really sad because it's and I sort of, there's a brain drain in the industry because it's a paper shuffle, and AI is getting into it, and they think they're going to take care of it. And I got off the phone with a guy this morning. I said, look, because I was hard stop with you guys. And I said, look, we've been talking for, 5-6 minutes now, but if you hadn't picked up the phone and called me, how long do you think this would have taken going back and forth on emails? It would have been days. So anyway.
All right.
Thank you.
Round 2.
Yeah.
Bye.
Next time on Commercial Connections.
There's just a disconnect between buyers and sellers right now. So you've got buyers unwilling to come down on prices. You've got sellers unwilling to meet them at the high prices. And there are still transactions happening, but that's a cash buyer or a 1031 exchange or a motivated seller. And there just aren't enough transactions to truly trend what's happening in the market. It seems like the trend will be stability for 2025. That being said, there's a lot of micro and macroeconomic conditions that could dramatically change that. If rates change substantially, that could change the environment, because in the environment where rates went up and transaction volume went down, we did not see the type of movement that we expected.